In today's video, there's a new $600 reporting rule, but this one benefits you, the taxpayer, and we have all of the details, so make sure you stay tuned. But before we begin, as always, welcome back, everyone. So very happy to have you back for another update. And this information can be found on IRS.gov. Simply type in the search news and search for the update dated October 21st, 2025. The Department of the Treasury and the Internal Revenue Service announced guidance for businesses required to report car loan interest under Trump's One Big Beautiful Bill. Notice 2025-57 provides transitional relief for 2025 for lenders and other interest recipients who are required to file information returns and provide statements to borrowers showing the total amount of interest received on qualified passenger vehicle loans and other information related to the loan. And that means that businesses that receive from any individual interest of $600 or more for any calendar year on a qualified passenger vehicle loan must comply with the new reporting requirements. Under Section 6050AA, any person engaged in a trade or business referred to as the recipient who in the course of that trade or business received interest of $600 or more for any calendar year on a specific passenger vehicle loan must file an information return reporting the receipt of that interest. Now let's go over how you will benefit from this new $600 reporting tax rule. Under Trump's One Big Beautiful Bill, there is no tax on car loan interest, and this new tax benefit allows certain taxpayers to deduct interest paid on a qualified passenger vehicle loan during a taxable year beginning December 31st, 2024 and before January 1st, 2029, provided the loan is incurred after December 31st, 2024 and the vehicle is purchased for personal use. Now, a qualified passenger vehicle is a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds and that has undergone final assembly in the United States. And under this new guidance, the IRS will consider that lenders have met their reporting obligation for interest received on a qualified passenger car loan in 2025 if they make a statement available to the buyer indicating the total amount of interest received. Specifically, lenders can meet their reporting requirements by making this total amount of interest available on an online portal that the buyer can easily access, or in a regular monthly statement, on an annual statement that is provided to the buyer, or by other similar means designed to provide accurate information to the buyer regarding the interest received. In addition, the IRS will not impose penalties on lenders for a failure to file information returns and provide payee statements if they satisfy their reporting obligations as described in the notice. And Section 6721 imposes a penalty for any failure to file an information return on or before the required filing date, and for any failure to include all of the information required to be shown on a return or the inclusion of incorrect information. Section 6722 imposes a penalty for any failure to furnish a payee statement on or before the required furnishing date to the person to whom such statement is required to be furnished, or for any failure to include all of the information required to be shown on a payee statement or the inclusion of incorrect information. Section 672A provides that no penalty may be imposed under Sections 6721 and 6722 if it shows that any failure was due to reasonable cause and not willful neglect. And that brings us to the end of this video. Please share your comments about this new $600 reporting rule and how it will benefit you. And don't forget to subscribe, hit that notification bell, and come back for more 2026 tax filing season changes and more. Bye-bye.